Miller-Orr model. This is one model that can be used to manage cash. It is used to set a target cash balance for the company. The model sets a high and a low point of cash for the company to hold. The model also sets an ideal cash level called the return point. See the diagram. Line H is the maximum cash the company will hold, and line L the least. And Z, you may have guessed that this is the target cash balance or return point Z. And now you see a yellow wavy line on the diagram. This is the actual cash balance in the company. And as you can see, over time it is high and it is low. This model identifies the highest and lowest level of cash the company should hold and the ideal balance it is striving to reach and maintain. Once these high-low limits are hit, action is taken. You will see at point X that the cash level is well above that of the target. This cash should be put into market securities and not just left in cash. Ideally, these securities will give a good return and the company will grow. How much should be put into the security? The amount from point X to bring the balance right down to line Z. So let's say point X equals $150, H $110, and Z $50. The amount transferred into non-cash securities is as follows. 150 minus 50 equals $100. By transferring this, the cash balance is brought back to the ideal Z. You could say the company is a bit sloppy at applying this model, having let the balance go to $150 when it should not go past $110. Now, having a cash balance that is too low presents a whole other set of difficulties. I'm sure that you would agree. Here, let's say the minimum level is $25. And we see that point Y is below that. What do we do if the cash balance hits its lowest threshold? Or even lower than that, to point Y, which is $5 in this example. You should know by now that the company wants to maintain its cash levels at the return point. So in this example, it is $50. So the company would convert its non-cash securities into liquid cash to restore the cash balance to Z. How much does the company need when it is at point Y? To restore the cash balance to the ideal, it is $50 less point Y of $5. So it needs $45. Okay, so you now know how the model works. How do you set up this model? Firstly, you need to set up the maximum and minimum points. The minimum point is set based on management culture and experience. It is guided by how much cash shortfall the company is willing to accept, and the market circumstances, meaning how easily cash securities can be converted and borrowings can be assessed. So, for example, in a market where cash is hard to come by and borrowing costs are high, the minimum cash level will be much higher than in a market where interest rates are low and borrowing is cheap, and the non-cash marketable securities are easily converted into cash. So, as you can see, there's no exact science in setting this level. It involves management's attitude to risk, the ease of converting marketable securities, and the ease of borrowing. The maximum cash balance can be calculated once the minimum has been set. This is calculated using the spread calculation. This formula gives the difference between the max and minimum points, i.e. the spread. The formula is spread equals 3, open parentheses, and then 3/4 multiplied by transaction costs multiplied by variance of cash flows, then this calculation is divided by the interest rate to the power of 1/3. This formula requires variance of cash flows. These should be in daily terms. What is variance? It is the standard deviation squared. Once you know the spread, the maximum point is found by adding the spread to the minimum point. What about the ideal cash balance or the return point? The return point equals the lower limit and then add that to 1/3 multiplied by the spread. You can see that each point feeds into the next. Okay, now let's tackle an example. I want you to attempt the example that will come up on screen. Pause the video and apply the theory we just did, and then I will review it with you. So pause the video now. Fashion Incorporated is a successful retailer, and the directors have decided the lowest the cash balance can go is $10,000. Transferring money to or from the bank costs $25 per transaction. The standard deviation is $1,500 per day. The interest rate is 0.03% per day. The directors need to know what is 1. The spread between the maximum and minimum amount of cash the company should hold. 2. The maximum balance of cash the company can hold. And 3. The return point. Did you attempt the question? It's your last chance to pause the video. Remember, we learn by doing. Okay, so we need the spread, the maximum and minimum cash the company can hold. Let's work through them as we see them. The spread equals, and then we've got the formula. So the transaction cost is $25. Variance is the standard deviation squared. The standard deviation is $1,500. It is squared, and that's $2.25 million. The interest rate is 0.03%. So let's apply the formula. So we've got 3, and then inside the brackets we have 3/4 multiplied by 25 multiplied by 2.25 million. That's divided by the 0.03%. And then that's all to the power of 1/3. And you get $15,600. That is the spread. That's the first part of the question answered. Part 2, the maximum balance of cash the company can hold. We now know the spread is $15,600. Add that to the minimum balance is $10,000. So the maximum balance is $25,600. Now let's calculate the return point. The return point equals lower limit plus 1/3 multiplied by the spread. The lower limit is $10,000. The spread is $15,600. 10,000 plus, and inside brackets 1/3 multiplied by 15,600, which is $15,200. Now you know the ideal point is 15,200. This is the cash balance Fashion Incorporated should have. The maximum point is 25,600 and the minimum 10,000. The benefits of the Miller-Orr model is that it gives clear cash balance parameters of how much cash is ideal, too little or too much. It also gives actions of what to do when cash is too low or high. The activity of implementing the model is great for an organisation, as they must analyse and dissect the company's cash needs. The main disadvantage is that there is no objective guide in determining the minimum cash limit, cash balance.